You've heard of heroic labs by now, and we keep talking about them because in today's mature market, you need every edge to be successful. Rather than spending those precious company dollars on building game tech, focus on building your game and shipping it. Get into your players' hands faster and grow your community. Heroic Labs is battle-tested partner and friend of the podcast. Their tech enables you to be flexible, creative, and scale for success. Heroic Labs has your tech stack covered. Whether you're looking for a world-class back-end game server, an amazing game development framework, fantastic live ops tooling, or reliable mass scalability, Heroic Labs has solutions for all of these challenges. And it's not just us at Deconstructor of Fun praising Heroic Labs. The company works with some of the world's biggest publishers on many of the beloved games. Focus on your game, save a big chunk of cheese, and avoid tech risks with Heroic Labs.
Hello, everyone, and welcome to our Deconstructor of Fun interview series. I'm your host, Jen Donahoe of This Week in Games, is the normal thing that you hear me on, but today I'm going to be doing a panel interview. I'm also a strategic marketing consultant at Beta Hat Research and Jade Inferno Consulting, if you wonder what I do in my day job. In fact, in my day job, I don't often get to talk about the topic we're talking today. In my history, I usually worked at the bigger companies. So I worked at EA, Zynga, Riot, Scopely, and only recently did I get a chance to even work at a startup and deal with the topic of funding and VCs and how do you get money when you're a tiny little company. And so a lot of this is new to me. And because it's new to me, I thought, well, maybe it's going to be actually new to a lot of different people. And so what I wanted to do was gather some experts and ask them a bunch of questions about the idea of VCs in general, VCs in gaming. And so I sourced a bunch of questions from the Deconstructor Fund community. Thank you so much for answering me on Slack. So here are some of the things that we're going to cover from not only the basics, but getting into just a lot of different areas of how funding works and how VCs work and how it might intersect with what we're trying to do as game makers. So how do VCs work? How do you all make money? What does good look like for a VC? How the investment process works. Why does a VC take a lead position? VCs in the board structure, and what is important to a VC as game companies are pitching? What is it that we all need to bring to the table to get funding? So today I'm honored to have three experts here who are going to school me on all things fundraising and VCs. So we have Sikandar, Yuri, and Anton, and I probably already butchered your name because I'm a dumb American and I'll do my best. So why don't I let you all introduce yourselves? So Sikandar, why don't you go first?
Hi, Jen. Thanks for having me. Great to be here. And you didn't butcher our names. I think it's a very good pronunciation. So I'm a principal at Transcend Fund. My background is a mixture of investment and games. Spent the first 5 years of my career in investment banking. I went home every day, very late in the evening, and played games until late and wondered if that was the right thing for me. And so left that and decided to try and focus more and more on games. I spent a couple of years at a few different funds, all the way from public internet equities, where I managed to get my first taste of looking at games. And actually, at the time, one of the best investments that the fund made was in games. And I realized this is, where I really wanted to focus on. So I did that for a while, then joined LVP, where I was doing early stage gaming VC for a year, and then moved on to Newzoo, where I was joined their consulting team, working with mostly gaming companies, but also media companies and anyone in the gaming ecosystem doing special projects in gaming. So that could range from helping them understand the viability of new games all the way from helping companies enter the gaming market. And so I got a really strong and deep understanding of the gaming audience, and then joined Transcend Fund 2.5 years ago. And in Transcend Fund, we're an early stage gaming VC, primarily focused on seed. We have around 37 portfolio companies. And most of the investments we have made to date have been in content. I'd say we're a content specialist. We invest across the gaming ecosystem, so anything that supports or touches the gaming audience, we will invest in. But more recently, we have done quite a few investments in the PC console space, but also in mobile and also outside of that. So yeah, I think we really focus on helping gaming entrepreneurs. That's how we set up our fund, and that's our specialty.
Oh, amazing. Time at Newzoo too. I mean, you've seen it all. Inside, outside, investment
Indeed.
banking. Oh, that's amazing. Yuri, why don't you go next?
Hey, thanks for the invite, Jen. So my background is in more the ecosystem side and as a founder myself, but outside gaming. So I've had a company myself where we utilize AI to build this business coaching platform, but I won't really go into that. That's kind of been my side project for a while now. And I've also worked in the Finnish startup ecosystem, for example, running kind of a lot of the games program for Slush, which I assume a lot of the listeners here are aware of, and joined the fund through that experience, and currently working as a principal at Sisu Game Ventures, which is actually one of the oldest game funds, as we know of at least, with LVP and Initial being on that category as well. And at Sisu, we really utilize a long history of the partners being studio founders and studio directors across 16 game companies over the last 30 years, for example, having founded companies like Funcom and Remedy back in the day. And we invest primarily in content at pre-seed and early seed, but we do look at adjacent platforms, mainly B2B in the industry as well, but we haven't necessarily ventured that deep into sort of the consumer platform side of the industry if it's not on the content end. And our focus is really trying to be hands-on with companies from the very, very earliest stages in every possible way.
Got it. So very early stage, a little tech focus, a little B2B, supporting the ecosystem, if that's what I'm hearing.
I'd say maybe 80% content and the rest is sort of in that B2B area.
Okay. A little bit of both. And then finally, Anton, who hosted Mishka and Phil, I guess, last week at the party where Phil mispronounced or mislabeled the DJ, I guess. I'm into Metallica and 90s alternative rock, so I had no idea who the DJ was he was trying to talk about anyway.
100% you would recognize the song though, but it was Darude and Sandstorm, and that actually came in with like a big surprise to a lot of guests that this guy is actually Finnish. So I think Mishka and Phil had a really good time over there. No, but thanks, Jen. Happy to be back on the podcast after a long break, after doing a bunch of Web3 episodes back in the day with Ethan, so I'm really happy to be back. So for the audience listening, I'm Anton. I'm a partner at PlayVentures. I've been part of the Play team almost since the inception of the first fund. And prior to that, I co-founded an analytics company here in Helsinki back in 2018. And then soon after, when Play was founded, I joined that team to fully focus on games investing. Prior to my own entrepreneurial endeavor, I also co-founded a micro VC fund here in Helsinki, backed by the founders of Supercell, Skype, and some other Nordic entrepreneurs. Very much focused on generalist investing at the time, but through that I also found my true calling of working together with gaming founders and really getting in the weeds in investing at the earliest stages into these companies and these teams. So throughout that career, I've been working mostly with gaming startups on an operating or in investor role in the past years. Similarly to Jere and many other active startup industry participants here in Finland, I was also involved with Slush back in the day, and that's where I got the introduction to the wonderful world of VC and startups. And I think me and Jere share a lot of experiences from there that has helped us also getting into this part of the industry. On PlayVentures, briefly, so we're a gaming-focused VC firm founded in the end of 2018. Currently, we're managing 5 funds, actively investing at the pre-seed and seed stages of startups, and with some Series A also added in the mix as well. And I would say from our investment focus, we do invest globally. We're mostly based out of Helsinki and Singapore, with some team members spread out across Europe and Asia as well. And the 3 pillars that we're investing against, first off, we have the game studios, mostly focused on mobile also because our team background consists mostly of founders and operators from the mobile gaming space. The second pillar is really about platforms and tech, supporting the broader gaming and the broader mobile industry. And as a third pillar within our new fund is something we call playable apps. And with that, we refer to consumer internet experience primarily on mobile across different verticals like wellness, sports, fitness, lifestyle. And these are products where we see that mostly former gaming founders come in and apply the best practices and the learnings they've had from building mobile games for decades and putting those to use in other verticals as well, kind of bringing the best of user acquisition, live ops, UI, UX, monetization design, and really appending these other parts of the mobile industry. So those are kind of the 3 pillars that we're investing against. And of course, for any founders out there listening, and if you feel like you're hitting any of these buckets, please hit us up.
You hit a lot of buckets there. I love the third bucket. That's really unique and very smart. We're hearing a lot of, it used to be called gamification, where I think Duolingo or some of the language apps are very well known for taking some of the best practices that we have in games and applying it to their consumer apps. So really interesting that you're diving in there. So let's bust in. Let's talk a little bit about VCs in general and start with some basics. We'll get that out of the way pretty quickly, but who wants to take the basic question? How does venture capital work and how do VCs make money?
So I'm happy to take a stab. VCs about investors investing in the equity of companies, subsequently taking part in growing the company's value, and then eventually taking part in also in the equity upside of selling the company either through M&A or IPO. So either a merger or an acquisition, or then going public on the stock market. Some things that are important to remember, and this also relates a bit into what VCs are looking for. VCs generally invest in very, very high risk investments, and that then it generally correlates that the earlier you invest, then the more risk you also take on. And also to help set the discussion a bit, a general rule of thumb, if we take a fund of, let's say, between 5 and 35 companies that early stage funds usually tend to target, the expectation in general is that almost half of your companies are likely going to return nothing. That we are talking about such high risk investments here. From the rest of the half, a chunk of these, the expectation is that you get your money back. A few of them might return decently from between 5 and 10x, and say 1 or 2 per vintage tends to return the whole fund by themselves. So this kind of underlines the importance of like what is the potential upside of the companies that the VCs invest in, as this model more or less demands that each and every investment has like in theory, the chance of becoming so big that it could return the whole fund by itself, because that's essentially what's going to keep the VC in business, and that's what allows the VC to raise their next fund and focus on finding the next big outcome. That then kind of dictates more or less kind of how we think about what is the expectation of the companies we invest in and what's their role kind of in the broader portfolio. And we expect that 1 or 2 of these companies that we invest in per every vintage, which is usually a 4-year period throughout which a fund invests actively through, that some of these will be the big winners that then allow the VCs to stay in the business and continue investing.
Yeah, and to add to that, I think it's kind of important to note for example, Sisu and Play here. I think Transcend is a bit of a newer fund, so it's not necessarily true yet. But this has this kind of power law dynamic that Anton described here has been the case, I believe, for both of our funds. So for example, for Sisu, Small Giant Games was our largest exit historically, and that returned the fund multiple times over, with the other investments not necessarily being even anywhere close to that number. And VCs, while they put the general partners of the fund, put a bit of their own money in to align incentives, VCs are ultimately investing other people's money. And who those people are, be they strategic investors in a certain industry or just pension funds, might matter. But ultimately, you're trying to beat a certain benchmark for returns of the capital that these limited partners, as we call them, are putting into the fund. Usually, the fund life cycle might be in total 10 to 12 years, and that can be extended if there are high potential investments still in the portfolio. But if you think about comparing a 10-year period to, for example, an index fund, you'd expect to make, in a good scenario, 2.5 to 3x the capital that's been put into the fund by these limited partners. And if you don't, you're not beating that index fund. And it is incredibly difficult to make a 3x as a venture fund, especially the higher the amount goes that you've so far raised.
Yeah, and I would reflect what Anton was saying around higher risk. And if you are a team looking for venture capital money, you need to make sure that you are presenting a very, very cohesive pitch, not just about what product you're creating or game you're making, but the team that you're presenting to a venture capital business, because they are investing just as much in the team and the earlier in some aspects more than the product and the market. And that includes basics, just for example, making sure you have the right founder equity structure, right? So if you have a few co-founders, you want to make sure that these co-founders are well incentivized through having, the right amount of equity in the company. Otherwise, it won't make sense if, it's just one founder and there are 2 or 3 other critical people, but they're not sufficiently incentivized. So the way that you structure your cap table, the way that you structure your founding team, and the way that your team thinks about the business, the mindset of the team, that they want to build an enduring business that can reach that outcome that is, potentially going to return 3 times the fund of the investor, that needs to be somewhat indicated through how the team thinks about the business. And it's not just hey, we want to create a small product or a game that we love, but hey, we want to build a business. And, that's what we're going to spend, all of our time doing. That needs to really be communicated. So I think that's one important thing that I think founders that are thinking about getting venture capital funding should have always in their mind when they're speaking to venture capitalists.
You mentioned cap table and equity. Can you talk a little bit more about what you mean by that? And you said it's good for them to think about structuring that correctly. What's your recommendation on how people should approach that?
Yeah, I don't think there's a one size fits all, but generally, if you have, let's say, 2 other co-founders, there's 3 of you, and you are all, critical to the success of the company in some shape or form, it's not uncommon that it's equally split. But at the same time, it's also not uncommon that, let's say, the CEO co-founder has a little bit more, and there's slight variations in how much the other co-founders get. But I think typically the key thing is they have to have a substantial amount of equity in the business. So it can't be, the one co-founder has, say, 90% and 2 of them have 5% each, because it really just indicates that the other 2 co-founders may not be as critical to the success of the company. And if they are critical to the success of the company, then they should be, rewarded. So you just have to make sure that they are happy with what they have, and they feel like they would have a real incentive to drive that outcome. Let's say it's 5 years down the line where you're thinking about an exit, or how big that exit should be and how much they should be rewarded for that. As long as they feel like they have enough of a stake in the company and it makes sense to the venture capital, then I think that's fine. There's no one size fits all, but ideally it would be somewhat similar in terms of how much each co-founder has.
Yeah, while something like 10% for a founder initially might seem like quite a lot, it easily gets diluted to less than half that in due time, especially if the company ends up raising more than, let's say, 3 rounds, which is quite common, especially outside the game industry, but perhaps less common in games.
Oh, maybe unpack that a little bit more. When you say gets diluted, talk through, maybe why they should start at a certain amount, and each round, like from pre-seed to seed to Series A, because people are coming in, you need to give them equity, correct? And so is that what you mean by dilution?
So, it's more about that you create new equity, which then dilutes the previous equity. And as part of funding rounds, when you bring in new investors, usually they will mandate, and as a founder, you should kind of mandate this yourself, an option pool that gets distributed to employees, potentially other founders if they've been diluted far too much, especially if the founding team is quite large. This might happen. So you might expect yourself to dilute even more than 25% each round. And in the current market environment, that is quite common, and even might be more than that, given how difficult it is to find funding and how much more of a sort of investors market we are currently living in. But the usual dynamic is that initial rounds might dilute you more, especially seed and Series A's. But as you get toward a more established company that has a strong position on the market, you have much more leverage in finding new capital and diluting, for example, 10% in a Series C, for example.
Oh, interesting.
Yeah, no, I was just going to add to that. I think the interesting part of this question is, well, there's a lot of, let's say, hidden truths or stuff that's not really out there, like in blog posts and anything. And it's really like about seeing it from the inside and having more experience about like what's too little and what's kind of too much. It really comes down to what Sikandar said about like, how do we make, like, people want to make sure that everyone's incentivized properly in the company. A common pitfall, for example, is that, let's say, a company at its pre-seed stage is raising from angel investors, and those angel investors end up investing, let's say, around maybe a few $100,000, but they end up owning 50% of the company. That's what VCs could consider as a broken cap table, because you feel like okay, the company has given already this much away of the equity. You have to take into account the future investment rounds that the company is going to be raising. Like the investor likely also wants a fair share, which is likely between, let's say, up to 10, maybe 15% of the company, to make sure that it also works with their fund model. And suddenly you end up in a situation where, let's say, the company still might be pre-product market fit, but the founders have already diluted to less than 50%, because the VCs also think about the next round, okay, that they have to extrapolate that, okay, will the investor of the next round be concerned that, there's too little equity for the founders left here? Is there too much equity with people who are not contributing full-time to this company? As I would say that's a big importance for us. I would assume both Yuri and Sikandar agree with me as well, that you can have all the flashy advisors on the cap table as well. But ultimately what gives us the most comfort is that we're seeing that the top tier team who's working on the project full-time are properly compensated for the equity, because that's ultimately the story that everyone's building against in these startups.
And these sort of broken cap tables often especially happen in less established sort of venture ecosystems. We tend to see this quite commonly in, for example, some Eastern European companies where angels have just taken a share that is both detrimental to the company and by extension to themselves, which just means that there's a lot of lack of sophistication in both kind of the company and the angel investor.
Oh, interesting. That makes a lot of sense. Anton, I want to ask you a little bit about gaming VCs in general, and what are they looking for? I mean, you said that you have 3 pillars. That goes pretty broadly. There's content, there's platform, there's distribution. What is it that you think gaming VCs are looking for, and how can founders who are trying to build different things, almost choose the right home for them based off of what their ideas are?
I want to preface this by saying that not any sort of specific. We're looking for companies in what probably fall into all of these buckets. But the common traits would be obviously a superstar team, having something called a founder market fit. So not only an interesting idea, but seeing that the team actually has a credible story and the chops to actually go and execute on that vision, and that what they've done previously somehow translates well into what they're doing now, which is another way of saying that the team has unique insight about something, and that's usually then materialized through obviously a lot of work in the past and figuring out that, okay, this is a real problem we need to tackle. There's a real opportunity here that we want to go after. So gaming VCs, it's a relatively new phenomenon. When we look at some of the biggest successes in gaming startups, like the Supercells and the Kings and the Scopelys of the world, when these companies received their pre-seed and seed investments, there weren't too many gaming VCs out there in the market. It's just like LVP here is the OG who was involved with Supercell, obviously, very early on. Sisu has also been in the market for very long. But really, we came into the market in 2018. A lot of the other funds have also come into the market in the trail of after the success cases kind of proved that gaming VC is a thing, then the gaming funds were also kind of a response to that, having worked in the market. So in a way, we're operating in a market that is also getting more mature, but that highlights the importance that at least we at Play, that we're looking for interesting openings and opportunities in the market that are supported by very strong tailwinds. You're more likely to succeed in a pie that is growing, where it's getting bigger for everyone and you get to take your own share, instead of fighting for your share in an existing pie that has a lot of big pie eaters already on the table. This is, for example, also a good segue into why we have also started to increasingly, aside of our games investments, to also look at these, what we call playable apps. As we're looking at a very mature ecosystem of mobile. Gone are the days of hundreds of millions of new devices coming to market every year, people downloading their first apps, figuring out what games to play, not as crowded UA channels, etc. So we believe that, and I believe as well, that those pockets are just very, very, very different. And it's important for VCs to keep evolving also themselves and finding those new opportunities in the market. And when it comes to the apps part, and just to give a bit more context there, we look at App Store revenue. 70% is games, despite games only being a subcategory of apps that are out there. But then we asked ourselves the question, is it just impossible to monetize anything else than games on mobile? Or are all of these other categories just underdeveloped and are far, far behind from mobile games? We chose to believe the latter. And that's now, as we see, supported by tailwinds, that that non-gaming app spend is looking to surpass gaming spend by 2030, at least according to Data AI's reports. So kind of the old adages that have been discussed also on this podcast multiple times: interesting teams, product market fit, growing markets, unique insight, and strong tailwinds into what you're doing.
So, Sikandar, I think you have a perspective on this as it relates to risk as well.
Yeah, I mean, just in terms of the topic of what platforms, to invest in and how that changes the shape of risk. I mean, we at Transcend, we've taken the view that sort of eventually cross-platform is going to become more and more of a mainstay for gaming. And even though it's been spoken about for a while, it's still, I'd say, fairly in its infancy. We haven't really seen many true cross-platform games come out. I mean, I think, MiHoYo, for example, is sort of the gold standard of what can be done with cross-platform. And there are obviously the bigger games out there that like Fortnite and others that have gone to that point. But, from our viewpoint and our kind of the way that we're investing and how we view risk, we're not taking a very, very strong position in which platform is going to be, let's say, the place that the next new big franchise is going to come out in content. We're investing across all platforms, so whether that's PC, console, mobile, even VR, XR, we've made investments in all those space. But we kind of believe that both the teams that are building interesting new IPs are going to be on all these platforms, and each one will have the differences in how you think about the risk of that content. Yes, PC and console, I think, has a little bit more difficulty in, say, figuring out what will stand out. But then in terms of the way that you can reach audiences and sort of almost kind of like the UA in PC console is a little bit more interesting, and there are lots of different ways to reach your audiences compared to mobile. Whereas in mobile, there is a lot more data-driven, early ways to validate your game. But then, going against kind of the current landscape of UA is very, very difficult. And so there are differences in each platform and how we view risk. VR, for example, I think is seen as a slightly niche category, but we believe it's going to grow a lot, and we believe that the potential for a new kind of franchise or IP is pretty strong there. And you're seeing the likes of even Gorilla Tag already reaching that status, right? So the way that we view risk just depends on both the platform and the audience and the go-to-market and all the things that you think about when you're building a business, and they're different for each one. But ultimately, we are not saying this is going to be the platform where the next new IP is coming from. We will invest in all those platforms because we believe that kind of true cross-platform will be the mainstay in the next 5 to 10 years. And so, yeah, the way that we speak to teams and the way that we assess risk is really through those lens, and it really depends on all of those different things that affect how they will grow and how things will pan out.
So, Yuri, for Sisu, do you have a specific focus around content platform? You said earlier like 80% content and 20% tech, right? The technology, the B2B technology, or did I get that wrong?
Yeah, so I mean that's kind of roughly it, even though we've never sort of specifically defined that. And in terms of content, we are relatively platform agnostic, even though historically, I mean, obviously I mentioned Small Giant Games. Most of our exits have come from mobile, but we've had some success in PC console as well. Which is part of why we're also interested in looking at the category more. But as Sikandar said, you just have to look at those categories, and especially distribution in those categories, rather differently. I mean, for example, in PC console, we often hear people reference some of these reference cases of studios that have grown to a certain size of over $1 billion valuation, for example. But when you look at them closer, they've often taken 20 years or even more to get to that stage. So growth in that category just tends to be a bit slower. For example, mobile for us, it is still very, very interesting, but we have to look at it as a very mature market. I mean, if you look back to the start of the kind of mobile craze and apps on mobile, you could realistically make things work with very sort of rudimentary approaches to the value that you're providing to the user. But in for example, mobile games nowadays, once the mobile UA arbitrage has really gone and you're looking at a very mature market, then you're back to really looking at what problems do you need to solve as a mobile studio in order to grow? And a lot of the times those problems are going to be less about design and more about distribution, which is why exactly those distribution advantages are extremely important to us, and really articulating that venture case through a distribution advantage is both important in both mobile as well as PC. And usually we would try to be very conscious of what like constitutes that advantage in both categories. And I think one part that hasn't been mentioned so far is tech, which I think presents a pretty interesting category for venture investment in games, where I think we've taken, at least recently, a rather strong stance that we don't necessarily believe that most games-only tech investments are necessarily ever going to have that venture return profile. And instead, we've, for example, made the distinction that we'd like to invest in tech companies that use games as kind of a beachhead, because the requirements of game studios for something like analytics, for example, are often way more sophisticated than for traditional consumer apps. So if they can make it work in games, there's a distinct possibility that it can be more widely used if that's been taken into consideration initially. Or if it's a pure games related platform, then it just has to be extremely fundamental to games. And not to even mention some of the problems that these companies have in terms of selling their product to studios, which are very biased toward that build end of the sort of build or buy spectrum. But we've still made quite a number of tech investments recently, but it's all been with a very specific thesis around why this is a venture backable business. And it's not just because it's interesting games technology that can be widely used in studios.
This podcast is brought to you by AppsFlyer. In today's digital world, understanding your app's journey from discovery to download is more than just insightful, it's essential. Enter AppsFlyer, the leader in mobile attribution and marketing analytics that allows you to measure the full potential of your marketing efforts, making every ad dollar work smarter. With AppsFlyer, that's your new reality. Dive deep into data-driven insights that reveal exactly where your users come from and how they'll interact with your app. AppsFlyer, where your app's potential meets performance.
Step into the future of game monetization with Xsolla, the premier partner for game developers seeking to expand their reach and revenue. Xsolla provides a robust suite of tools designed to enhance user acquisition, manage subscriptions, and streamline payment solutions worldwide. Unlock new markets and maximize profitability through their customized, secure payment architecture and dedicated support team. Xsolla, powering game developers to achieve global success.
I think it's a very important point that Yuri makes about sort of B2B software companies only servicing the games industry. I think also has to do with the purchase power of these companies and kind of where in the list of priorities this software falls in with these companies. If we look at mobile, by far the biggest expenditure at scale is going to be your UA budget. And that's ultimately where you want to keep spending your money. And it's just really hard to build a massive venture case. Hence, we've also largely stood away from companies focusing on, let's say, providing some backend services for gaming. This is not to say that these couldn't make outstanding businesses on their own, and these will likely kind of continue growing and be very healthy businesses, but it comes back to the point of like, how big can these things actually get? And will they eventually also be able to return the fund? But as Yuri said, if you start looking then more horizontally as well, games and games companies are still great early adopters of these companies, largely also given the fact that you need to stay competitive in this industry and always be exploring the new way of having an edge over your competition. And so this thing gets highlighted in companies operating in the UA space or the marketing space or let's say in the broader distribution space. Be it, for example, sort of companies building out web stores such as AppCharge in our portfolio, allowing the studios to now, in the wake of DMA and kind of what's happening with Epic and Apple, forcing Apple to allow developers to open up directly to users and then being there to provide that service now that that market is opening. Or be it with this kind of an emerging form of rewarded installs that are making a comeback to market, specifically companies like Benjamin and Playback in our portfolio, who are then taking use of this first-party data they can gather from the users and actually try to leapfrog some of those conventional ad platforms and really providing users similar to as we saw in the pre-IDFA deprecation era. So we're very interested in founders kind of seeing these waves coming their way and some ripples in the market that allow them to kind of inject themselves in there and go and fill that vacuum. At its core, those are new markets being made. And as long as they are solving pain points for customers, they're able to grow and become really interesting to us. In content specifically, it's not kind of solving a problem in the same way, I would argue, but obviously you're catering to different needs and different interests of players. But even there, we would encourage teams and get excited about teams that have found, let's say, a very popular but lapsed genre in terms of like the market leaders being very old actors. Obviously, My Games did a very good job with Rush Royale there, kind of seeing tower defense as a great kind of lapsed genre, but taking the best learnings from Random Dice, the Korean game, and then launching that in the West and basically revitalizing a lot of the tower defense genre in the West. Or then an example again from our portfolio, Keck Entertainment, that are building in a niche that's not too well known, looking at very hardcore mech games on mobile, seeing that War Robots, the incumbent, is doing a lot of things well, but really leaving a wake for a new entrant to come and build within that niche, which on a spending level is still quite massive. So really looking for these kind of pockets of content that have been lapsed in later years and having a compelling thesis of, why they're actually going to come in there and not only eat the pie of the incumbent, but also growing that pie. And it might be better monetization, it might be making a game with a broader appeal. There's different things to this, but it all comes down to finding that sort of pocket that they seem that the incumbent is doing a bad job at, and then coming in and kind of eating their lunch.
That makes sense.
To quickly add to that, I think it's an interesting point to kind of compare investments in very mature genres and these more niche genres. I think from a PC console perspective, I think it's very interesting to look at something like Escape from Dark as an example of really hitting an extreme niche extremely hard and finding a lot of success in something that a lot of people wouldn't necessarily expect to be a large opportunity given how brutal and unforgiving the game is. But it's offering something that just simply isn't out there on the market and really doubling down on what players want from that, as opposed to something like trying to work things out in a MOBA category, which has been incredibly difficult in the last basically 15 years. There's a lot of dead entrants in the category. And for mobile, you could look at a mature category like puzzle and match 3 in particular, which is basically the biggest opportunity in games bar none. But it is so saturated and the incumbents are so sophisticated in both design and UA that it requires something rather special for you to enter that market and grow to venture scale.
So all of that makes a lot of sense. Trying to find places where maybe there's an incumbent who's gotten lazy, or, Yuri, to your earlier point, which was interesting about how do you use games as a use case for expanding and going more broadly? As a growth marketing person, I go to something called MAU in Las Vegas every year. It stands for Mobile App Unlock or something like this. And what I often see at those conferences is that everyone goes to all of the game panels, even if you are not in gaming, because gaming is the lead in how do you unlock new UA, how do you unlock new acquisition. And so I think that makes a ton of sense in areas you all want to focus on. So Sikandar, so pretend as if there are one of these opportunities and you see it. Pretend like they've pitched you and if you want to start at a pitch, that's fine too. And what are you looking for at a pitch? And then how does each of the stages work in terms of what they can expect until they get that check in their hand?
Yeah. So typically, how we even meet founders can be in itself a little bit of a black box to many founders out there. A lot of the founders that we speak to, come through recommendation from our network. Could be a founder of a portfolio companies that we already know. It could be someone in our network that is a founder elsewhere, or it could be really anyone that's kind of close to us or, has spoken with us in the past. But also, we do get a lot of, just cold inbounds and we do check those. And actually 2 of our investments that we've made have been through cold inbounds. So, it is also a way to reach us. But ultimately, you want to get our attention and you have to sort of hustle to do that, right? There's only so many pitches that we can see in a day. And I'd love to speak to everyone that messages me. And that there's so many cool ideas out there and incredible founders. But there's only so much time that we have, and yeah, just making sure that you can get in front of us in whichever ways possible, and be creative about it. I think we definitely appreciate that. So once you speak to us, it'll typically be one of the team members, and there'll be an intro call, and you want to definitely establish up front what is interesting about the fit between what you're building as a founder and the team that you're speaking to. And in our case, if you are building in the gaming space in content, there's going to be at least some interest in how you're going about it. But even if it's not in content, even if it's in tech or platform services, if it's something that's really enabling the community in games, or if it's something that's really, potentially enabling even the rest of our portfolio, then that's also interesting to us. But really that initial introductory meeting is to just establish whether there is a connection between how we think and you think, and just us to get an understanding of what is it that you're really driving for. I would say, don't go too much into the details of like, here is the, specific market, and here is, like the nitty gritty of everything we're building. Sometimes teams try to pack too much into that initial introduction meeting. And I understand why. You want to make sure you don't miss anything. But actually, I think sometimes less is more. And, through my experience as well with helping our teams that are raising their next round, is that investors are just as much emotionally driven as they are rationally driven. And we may like to say that we are, rational beings, and we do all the calculations in our head, and we try not to bias ourselves. But like ultimately, there's gonna be that level of, hey, can we see ourselves working with you long term? Can we see ourselves really helping you in getting to that next step and in building the vision out, for the next 5 years? Kind of, are we the right fit? And those kind of conversations, I think if you can get that up front, they really hit harder than just kind of the cold hard numbers of maybe what you're trying to do. So, you'd have that introductory meeting, and then, we're a small team of 6. And so we very quickly like to get the whole team on board over the next couple of weeks. It could be 2 or 3 more extra calls. But again, each call is for you to get to know us, for us to get to know you, for us to really understand, what is it that you're looking for in a partner and how that we can help you. But ultimately, what is driving you as a team as well? Your background and where you come from, really does make an impact of like why you are here today and what is it you're building. If you are a team that's building, let's say in the UGC space, whether it's Fortnite Creative or Roblox, then I think it just definitely helps if you're a team that's already done that in your spare time, or if you are a team that's building in PC console, then having run a game studio or having some kind of success under your belt. You don't have to be like the CEO of a previous company, but I think as long as you were really part of making the sausage of the game that was successful, really does help. And so all those things should be coming together and should show through your presentation, your pitch, and why you're passionate about what you're making. And so, we really want to understand that over 3 calls, maybe, could be 4. It really depends. And if conviction builds quickly, sometimes, within 1 or 2 calls, we've said, I think we really want to work with these people, let's put down a term sheet. And that's generally our approach. As long as you meet the whole team and as long as we feel a lot of conviction, then we can move fairly quickly. Being a smaller fund at least helps. I think we can move much more quickly. We can really very quickly understand whether you would fit with our wider portfolio as well. And so if there's somewhere where we want to move quick, we can issue a term sheet within a week. So I think that would be the general process.
Wow. Anton, any differences or similarities from your side?
I think Sikandar summarized that pretty well. I would say the process looks quite similar in broad strokes, and I would assume so for many other VCs as well. I really like what Sikandar said about kind of the importance of kind of the human aspect of it all. It's important to remember that the VC is also just a normal person doing their job as well, with both kind of rational and irrational characteristics. And it's a very common wisdom in VC overall and startup land that you keep hearing a lot this advice that, get a warm intro to the investor. But what does it actually mean? If I think from my point of view, it's also really about like when you look at pre-seed investing, you're investing in a team. It's all about creating trust for that person. As an investor, you're just trying to gather all of the available data points, all of the available information, which is going to be limited anyway, that helps you get over the finish line and actually build that conviction and invest. So hence why warm introductions have been popularized and kind of made the benchmark, so to speak, because when somebody you trust in your network introduces you to a potential founder, they're kind of putting themselves on the line also. They're putting their reputation on the line with little to nothing to gain from it. And that obviously gives a boost of confidence to the investor as well, that, okay, this person whom I really trust is actually buying for this person and kind of telling good things about them. Okay, I should definitely meet this person. This is not to say that you couldn't approach cold emails. We've also invested in companies based on a cold reach out to us. It's really about how do you frame your email in a concise way and kind of get the interest of the investors to jump on and hope on a discussion. There's multiple ways to do this. But again, it underlines the human aspect, and it's really about the investor actually building the required trust to pursue the investment.
So let's assume that you've built that trust, and now you're into the position where we need to think about board seats. Can you talk to me a little bit about how you think about being on the board and how the board operates and things that founders should know about boards?
Yeah, in general, the board can be a very powerful tool for the company, specifically the CEO, but also the other founders of the company. There is a VC here in Finland who led the pre-seed investment into Supercell that we had the pleasure at the Play Summit to hear some of his thoughts into what makes a good board for a startup. And he had a lot of interesting tidbits there, to which I agree as well, because boards can also be, let's say, not value destroying, but let's say definitely not value adding. My opinion, and also from working with multiple startups on the board, is that before you really have a business that requires a lot of strategic decision making, you're likely better off just working with, let's say, advisors you have on the cap table or your investors in a less formal manner, let's say doing bi-weekly catch-ups, or you do some other exercises, brainstorming that where you get more input for what you do. But where I feel like the board is becoming more valuable is that when you have reached product market fit with your company and there's more sort of vectors to pursue for the company where you really want strategic advice, and also in terms of more hands-on things like leveraging your board to help with convincing a new hire to join the company, or obviously also leveraging the board for investor intros and kind of helping with the round. But that's really sort of later down the line where there's actually more decisions to be made. Otherwise, generally, what we see in the earlier stages is that we try to move all of that board discussion offline instead, and then be more active outside of those kind of more formal things. In general, the VC I was alluding to a moment ago was saying that, which I really like, is that the board should be doing its everything to support the CEO until it's time for them to fire the CEO. So that's like a pretty harsh way of putting it, but that's in general what's happening, let's say, behind the scenes when you've heard about bigger companies where the CEOs have been replaced. Take Travis Kalanick at Uber, for example. That was an example where the board ousted the CEO because they felt that the CEO is not anymore fit to run the company. So the board acts as a steward for the company, but also equally importantly to be the most important resource to the CEO as well.
Yeah, I maybe often I tend to agree with Anton's hot takes, and I'll agree here that I'll give an example from our perspective where we don't tend to take board seats, especially at pre-seed, and just find that it becomes a rather useless rubber stamping activity where people feel the need to create presentations for something that can easily be handled over more casual calls with investors, which then changes quite a lot as you bring a lot of different stakeholders, in this case mostly investors, as part of the board later down the line, maybe after Series A, or not necessarily even after Series A, mostly when you are at a later stage, as Anton said, after product market fit. And we've been on part of some boards. Initially, I'm part of one currently, even though we don't take many seats. And in one case, we have had to do a rather sort of painful process of finding a new CEO. And that has been rather difficult for everyone, but ultimately ended up in a rather positive situation for the company, at least for now. But I definitely agree that there is a level to which these boards can be rubber stamping activities, but also kind of showcasing some ego even from some investors that can end up being very negative to founders, especially if these investors are not or have not been active in the industry and don't necessarily understand what they're working with. In those cases, you might end up really being there kind of explaining some rather basic concepts to people who still feel some sort of need to be a part of decisions that they simply should not be a part of. And at least we did consider that a legitimate problem. And even though we have made a lot of investments in the industry, I think like 84 by now, and the partners have been operators and founders, we still often don't think we have all of the information needed to give certain types of advice that we sometimes see given to founders.
Wow. Okay.
Yeah.
Makes sense.
I would also quickly add, I mean, in terms of governance, I think there may have been a period I felt during, let's say, the peak of the zero interest rate, heydays, where governance was sort of thrown out of the window. And, we've seen some big blow-ups in the past where after it all happens, people ask, where was the governance? Where were the investors? Why was no one checking what they were doing? And I do think that has some knock-on effect of, how people think about even structuring board at the early stage. And so as much as I agree that you want to work with your portfolio companies through casual catch-ups, and that's really where the meat of the upside gets built, I think the protection of the downside, there needs to be an eye on it. And, the board seat can be one way to do that, through, methods that you've already mentioned, if things are not going well, if the CEO needs to be changed. But even if some decisions are being made and, it has to be approved by everyone on the board seat, I think that can be at least helpful to protect some potential, mismanagement or wrongdoing. And oftentimes when that happens, there are bigger problems that a board won't solve, but at least it's a way to kind of figure it out early or to understand what's going on early. And I think the other thing that could be useful that I've seen is that when you have a certain board construction, and then that company goes on to raise a new round, you have new investors, you have a new board. Actually, sometimes it's helpful to have your old, board member, whether it's the old VC, to stay on as either the board or as an observer to kind of help transition into a new wider board structure, because you trust them, you want them to be involved in the discussions, and you want them to just kind of sense check new discussions that are going on with new board members. And sometimes that can give comfort to a founding team because they've worked with the old board member for ages and they have someone new joining, and sometimes it's nice to have them all together rather than sort of being handed over to a new set of parents without any kind of guidance. So I think that can also be helpful, but yeah, on the whole, I do think it is largely a formality and it's just there to protect the downside.
And to quickly add, because Sikandar mentioned observers, like for example, in our term sheets, we generally do not expect a board seat, but we may expect an observer seat that doesn't have a voting responsibility as part of the board.
Interesting. So how does that manifest? Do you go to the board meetings? How are you observing?
I mean, usually it is that you go to the board meetings, but if there is a decision that would require the input of the board and for example, a vote, then the observer just simply doesn't have a say in those cases.
Yeah, you can express your opinion, but when it comes to counting the votes, then you're off the table at that point in time. I do want to quickly underline what Jere said about these board meetings, especially in later stages and when there starts to be more observers and board members around the table of becoming investor Q&As. I see that even in like growing and very good companies happening every now and then, and that's just something that's unacceptable and something that the founders should really rally the people they trust around like eliminating that, because the investors in the company should know what the company is doing and understand its business. Always send the materials 1 week ahead before the board meeting. Make sure the investors have read that to kind of avoid overly repeating the stuff that's already been sent, because it's valuable time. You should see that board meeting as a tool to really pick the brain of the people around you and the people who support your business, and avoid them becoming sort of sessions where investors get to ask questions about how the business works. But unfortunately, that also happens in better companies that are out there. But I guess it's something we're all just trying to work to improve.
Reduce board bloat is what I hear you saying. That makes sense. We have come kind of to the end. We talked about a lot, but did we miss anything that one of you may want to jump in and capture in case we missed something?
Well, one thing I wanted to bring up, which Sikandar kind of briefly mentioned, is fund size, which I think is quite an interesting thing to look at, which founders don't necessarily have a lot of like a clear view into, where a fund size might affect the types of decisions that are made quite heavily and the types of companies that are seen as investable, and often also leads to something that is a bit confusing to a lot of people in the industry. For example, these massive rounds that happened at large valuations where like a multi-billion-dollar fund puts, I don't know, $50 million into a very early pre-product market fit stage company, because that's kind of just what they invest. They don't necessarily have a mandate inside a very bureaucratic organization to invest less than a certain amount. So when they do want to invest, and they want to invest when there's still upside available and potential multiples available in a certain investment, that's kind of what they have as the option. But for example, for smaller funds, like for example, Sisu is currently a $55 million fund, and the previous funds were much smaller than that. We look at certain opportunities somewhat differently, for example, based on valuation than another fund might. I mean, I'll give you an example here where one of the things we also do that not a lot of funds, to my knowledge, do is that we incubate companies where we get involved very early. Perhaps there's a CEO, but there's no team. There might not even be a very kind of clear idea of what exactly they're doing. But we commit to supporting, kind of building the early team, coming to that defined early strategy, and then take kind of a requisite stake in the company. And for example, with Sikandar, we have a common investment that comes from our incubation. I don't want to call it a program, but our incubation activities, which is Cosmic Launch, mobile game studio heavily focused on AI. And in those cases, we invest at a very low valuation. I mean, I think Cosmic Launch has a very high ceiling as a company, but in other cases, we, for example, look to invest in more indie type PC console studios. But if we get in at, let's say, 2.5 million valuation, that is a radically different sort of calculation than one you might make when you invest, for example, 4 million at 20 million valuation. You can get by with a very different exit for that company than you would if you were to invest at a larger valuation, which is exactly why fund size starts to matter a lot, because a multi-$100 million fund cannot necessarily invest, let's say, 200K. It just doesn't make sense for them in terms of what alternatives they have available to them.
I would also sort of highlight there that, let's say, even if sort of the fund size would be a smaller fund size would be more applicable for, let's say, take your indie PC console type of investment, I would argue that you also keep in mind during that diligence process about like, okay, if the company is going to need a follow-on investment, will this be attractive and big of an opportunity enough for that follow-on investor to then go and underwrite that next round? So even if you find this match with, let's say, a smaller fund, I think then it's important for that smaller fund to then get comfortable. Okay, this money will take them to a level where, for example, maybe it unlocks publisher funding, maybe it unlocks strategic funding or something else that will continue keeping this company in the business, but it might not unlock another VC. So a lot of nuance again to this question, but I think something worth pointing out.
Amazing. Well, thank you all for your time. I really appreciate it. Maybe we'll even do a follow-up because there's so many things we didn't even get the chance to touch on. So thank you.